I've been in this investing game for quite a long time now, more than 7 decades, if you can believe it. And during all those years, I've watched millions of people try their hand at building wealth through investing. I've seen brilliant minds fail spectacularly. I've seen average folks become extraordinarily wealthy, and I've seen patterns repeat themselves so consistently that you could set your watch by them. But here's what strikes me as most curious about all of it. If you were to ask 100 people what separates those who become wealthy through investing from those who don't, you'd get 100 different answers. Most would tell you it's about being smart, having a high IQ, graduating from the right schools. Others would say it's about having insider information, knowing the right people, or getting lucky with the next big thing. Some folks think it's about timing, about knowing exactly when to get in and when to get out, like some kind of financial chess master seeing 20 moves ahead. And I'm here to tell you that nearly all of those answers are wrong. Now, I don't say that to be provocative. I say it because I've lived it. I've watched it play out over and over again in every market cycle and every generation of investors. The truth is simpler than most people want to believe. And maybe that's part of the problem right there. We humans have a funny way of complicating things that are simple, because if something's too simple, well, it can't possibly be the answer, can it? Let me tell you what I've observed. I've known people with PhDs in mathematics who've lost fortunes in the market. I've known people who barely finished high school who built substantial wealth. I've watched folks with access to every piece of information imaginable make terrible decisions, while others with nothing but common sense and patience have done remarkably well. Intelligence helps, sure, but it's not the determining factor, not even close. Per ND luck? Well, luck is what people call it when they don't understand what's really happening. I've seen too many people get lucky once or twice and then lose it all. And I've seen too many people steadily build wealth over decades for it to be luck. No, luck might get you started, but it won't keep you wealthy. There's something else at work. The real difference, the thing that truly separates those who build lasting wealth from those who don't, is a habit. One simple habit. And before you roll your eyes and think this is going to be some obvious piece of advice you've heard 1,000 times, let me assure you, this habit is so simple that most people dismiss it entirely. They think they understand it, but they don't really practice it. They know about it intellectually, but they don't internalize it. They might even think they're doing it, when in reality, they're doing the exact opposite. Let me back up a bit and talk about what I see happening with most investors. Every single day, millions of people are making decisions about their money. They're buying stocks, selling stocks, moving things around, checking prices, reading news headlines, watching financial television, listening to hot tips from friends or colleagues. They're busy. Very busy. All that activity, all that attention, all that energy spent on their investments stop bar. Andy, you know what? Most of them would be better off doing nothing at all. That sounds strange, doesn't it? How could doing less lead to better results? But here's the thing about human beings and money. We get emotional about it. We can't help ourselves. When the market goes up, we feel excited. We feel smart. We want to do something to capture more of those gains. When the market goes down, we feel anxious. We feel scared. We want to do something to protect ourselves. These feelings are natural. I understand them completely. I've felt them myself over the years. But feelings and investing don't mix well. They really don't. Fear and greed, those two powerful emotions, they've probably destroyed more wealth than any market crash ever could. Let me explain what I mean. Imagine you're watching the news one evening and you see that the stock market has just had its worst day in months. Prices are falling. Everyone's talking about recession, about trouble ahead, about how this might be the beginning of something really bad. You check your account, and sure enough, your portfolio is down, maybe down quite a bit. Now, what's your first instinct? For most people, it's to sell, to get out before things get worse, to protect what they have left. It's a survival instinct, really. When we sense danger, we run. But here's the problem. By the time you're seeing that news, by the time everyone's talking about how bad things are, the market has already fallen. You're not protecting yourself. You're locking in your losses. You're selling low. And this is exactly when you should be thinking about buying, not selling, because everything's on sale. But it doesn't feel that way, does it? It feels like catching a falling knife. It feels dangerous. Now flip the scenario. The market's been going up for months, maybe years. Everything you touch seems to turn to gold. You're checking your account more often because it feels good to see those numbers go up. Your neighbor tells you about some stock that's doubled in the last 6 months. Your colleague can't stop talking about how much money he's making. You read articles about people getting rich quick, and you start to think, maybe I should be more aggressive. Maybe I'm missing out. Maybe I should buy more or buy into those hot sectors everyone's talking about. This is when people tend to throw caution to the wind. This is when they pour money into whatever's been going up the fastest. And this is exactly when they're buying high. They're paying top dollar for assets that are already expensive. And when the inevitable correction comes, and it always does, they're the ones who get hurt the most. See the pattern? Buy high when you're feeling confident, and everyone else is too. Sell low when you're feeling scared, and everyone else is too. It's the exact opposite of what you should be doing, but it's what most people do because they're reacting emotionally. They're letting their feelings guide their decisions. Now, the wealthy investors I've known, the ones who built substantial fortunes and kept them, they behave differently, not because they're smarter or because they have better information. They behave differently because they've developed a habit that protects them from their own emotions. They've learned to tune out the noise. They've learned to ignore the daily ups and downs. They've learned to think in decades, not days or months. Let me tell you about a friend of mine, and this is a true story. Back in the early days when I was first getting started, I knew a man who worked at a regular job. Nothing fancy. He wasn't making a fortune, but he had this habit. Every single month, no matter what was happening in the world, no matter what the market was doing, no matter what the news was saying, he would take a portion of his paycheck and invest it. Not a huge amount, just what he could afford. And he kept doing this month after month, year after year for over 40 years. He didn't try to time the market. He didn't move everything to cash when things looked scary. He didn't chase the hot stocks when things looked great. He just kept investing steadily, consistently, like clockwork. When prices were high, he bought. When prices were low, he bought. When everyone was panicking, he bought. When everyone was celebrating, he bought. Same habit, same action over and over again. And you know what happened? He retired a wealthy man, not because he was brilliant, not because he got lucky, not because he had any special information, but because he had this one simple habit and he stuck with it no matter what. This is what I'm talking about. This is the habit that separates the wealthy from everyone else. It's so simple that people overlook it. It's so boring that people dismiss it. But it works. It works because it removes emotion from the equation. It works because it takes advantage of one of the most powerful forces in the universe, something Albert Einstein supposedly called the eighth wonder of the world. I'm talking about compound interest, the ability of money to grow on top of itself over and over again, year after year. But compounding only works if you give it time. And that's where most people fail. They don't give it time. They interrupt the process. They take money out when they get scared. They stop contributing when things look expensive. They chase returns elsewhere when their current investments seem boring. They keep interfering, keep tinkering, keep doing something when they should be doing nothing. Think about planting a tree. You don't plant a seed today and dig it up tomorrow to check if it's growing. You don't uproot it and move it to a different spot every time the weather changes. You plant it, you water it regularly, and you leave it alone. You trust that nature will do its work. And if you're patient, if you give it enough time, you'll have a magnificent tree that provides shade and beauty for generations. Investing is the same way. You're planting seeds that will grow into something substantial, but only if you leave them alone, only if you're patient, only if you resist the urge to dig them up and check on them every day. Now, I want to be clear about something. This habit I'm describing, it's not about being passive in the sense of not caring or not paying attention to quality. You still need to invest in good businesses, in solid companies with real earnings and real prospects. You still need to be thoughtful about where you put your money. But once you've made those decisions, once you've chosen your investments wisely, the habit that will make you wealthy is to keep investing consistently and leave those investments alone. This means investing the same amount regularly, whether the market is up or down. This means not selling when everyone's panicking. This means not buying more aggressively when everyone's euphoric. This means being consistent, being patient, and trusting that over the long term, good businesses will create value and that value will compound I've seen this play out over so many different market cycles. In the 1970s, when inflation was high and people thought the American economy was finished, the people who kept investing did well. In the 1980s and 90s, when everything seemed to only go up, the people who stayed disciplined and didn't overextend themselves did well. In 2000, when the dot-com bubble burst and people lost fortunes, the ones who kept investing through the crash did well. In 2008, when the financial system nearly collapsed and it felt like the world was ending, the people who had the courage to keep investing did extraordinarily well. And in every single case, the people who tried to time it perfectly, who tried to get out at the top and get back in at the bottom, who tried to be clever and outsmart the market, most of them failed. They got the timing wrong. They let their emotions guide them. They bought high and sold low, even though they were trying to do the opposite. Here's another way to think about it. Imagine you own a farm. You've got good land and you're growing crops. Now, would you sell your entire farm just because it didn't rain for a week? Would you abandon everything because one season wasn't as good as you hoped? Of course not. You'd understand that farming has ups and downs. Some years are better than others. Some seasons are wet, some are dry. But over time, if you've got good land and you keep working it, you'll do fine. That's how you should think about owning pieces of good businesses, which is what stocks really are. They're not little pieces of paper or numbers on a screen. They're ownership stakes in real companies that employ real people and serve real customers and generate real profits. And like farms, they'll have good years and bad years. But if they're good businesses, over time, they'll create value. And if you own them and hold them and keep adding to your ownership, you'll share in that value creation. Habit then is this: invest regularly, invest consistently, invest regardless of what the market is doing. Don't try to time it. Don't try to be clever. Don't let your emotions push you into doing something stupid. Just keep putting money to work in good businesses and then leave it alone to compound over time. I know this sounds almost too simple. I know some people hearing this will think there's got to be more to it than that. There's got to be some secret, some strategy, some insider trick that the wealthy use. And I'm telling you, someone who's lived this life and seen it all, there isn't. The secret is that there is no secret. The trick is that there is no trick. The strategy is to not have a strategy beyond steady, consistent, long-term investing. But simple doesn't mean easy. There's a difference. It's simple to understand, but it's not easy to do because it requires discipline. It requires patience. It requires you to go against your natural instincts. When everyone around you is panicking, you have to stay calm. When everyone's getting rich quick and you're plodding along at a steady pace, you have to resist the urge to abandon your plan and join the party. That's hard. That's why most people can't do it. Let me share something else I've learned over the years. The people who do best in investing are often the ones who care the least about the day-to-day movements. They're not checking their portfolios every hour. They're not reading every headline. They're not glued to financial news. They're living their lives, doing their work, spending time with their families, and every month, automatically, they're putting money into their investments. They might check in once a quarter or once a year maybe, just to make sure everything's still on track, but otherwise, they're leaving it alone. Compare that to the person who's checking prices multiple times a day, who's reading every article, who's constantly worried about whether they should buy or sell, who's moving money around trying to optimize every little thing. Who do you think does better over 20, 30, 40 years? It's not even close. The person who does less, who stays consistent, who remains patient, they win almost every time. There's this wonderful paradox in investing. The more you do, the worse you often perform. The less you do, the better you perform. Activity feels productive. It feels like you're being smart, being engaged, being on top of things. But in reality, all that activity is usually just creating friction, generating costs, and causing you to make emotional decisions that hurt your returns. Now, I want to address something that I know is on some people's minds. What about those stories you hear of people who made millions trading stocks, or who got in early on some tech company and got rich? Don't those people exist? Sure they do. But let me tell you what you don't hear. For every person who got rich that way, there are hundreds, maybe thousands, who tried the same thing and lost money. You hear about the winners because their stories are exciting. You don't hear about the losers because failure isn't newsworthy. It's like hearing about someone who won the lottery. Yes, people win the lottery, but if your financial plan is to win the lottery, you're going to be disappointed. The smart plan, the reliable plan, the plan that actually works for most people is to save consistently, invest consistently, and let time and compounding do the heavy lifting. And here's the beautiful thing about this habit. It doesn't require you to be special. It doesn't require you to have a lot of money to start. It doesn't require you to be brilliant or lucky or connected. It just requires you to be disciplined and patient. Anyone can develop this habit. Anyone can benefit from it. But most people won't because it's boring, because it doesn't promise quick riches, because it requires delayed gratification, because it asks you to think in decades when we live in a world that thinks in days. I've often said that the stock market is a device for transferring money from the impatient to the patient. And I've seen this proven true again and again. The impatient investor is always looking for the next thing, the next opportunity, the next way to get rich faster. They're always doing something, always moving, always chasing, and often they're always losing, even when they don't realize it, because their returns after all that activity are mediocre at best. The patient investor, on the other hand, finds good investments and holds them. They keep adding to them. They ignore the noise. They don't get shaken out when things get tough. They don't get overly excited when things are great. They just keep doing the same thing year after year, decade after decade, and slowly, quietly, without fanfare or excitement, they build substantial wealth. Let me give you one more way to think about this. Imagine two investors, both starting with the same amount of money. The first investor tries to be smart. He moves in and out of the market. He sells when he thinks things are too expensive. He buys when he thinks things are cheap. He's constantly adjusting, constantly optimizing, constantly trying to outperform. The second investor does nothing fancy. She just invests a set amount every month, no matter what. She doesn't try to time anything. She just keeps putting money to work and leaving it there. Now, you might think the first investor, with all his activity and effort and cleverness, would do better. But the research on this is very clear. Over long periods of time, the second investor almost always does better. Why? Because the first investor is going to get some of his timing wrong. He's going to sell too early sometimes and buy too late other times. He's going to let his emotions influence him. He's going to incur transaction costs and taxes from all that activity. And all of that is going to eat away at his returns. The second investor avoids all of that. She's not trying to be clever. She's not trying to outsmart anyone. She's just being consistent. And consistency over time beats cleverness almost every single time. So what is this habit I've been talking about? I think by now you've figured it out. It's the habit of investing regularly, consistently, and patiently, regardless of market conditions. It's the habit of not trying to time the market, not reacting emotionally, and not interfering with the power of compounding. It's the habit of doing the boring thing, the simple thing, the thing that doesn't make for exciting stories, but that actually works. Some people call it dollar cost averaging. Others call it systematic investing. I just call it common sense. You're buying more shares when prices are low and fewer shares when prices are high, but you're always buying. You're always moving forward. You're always making progress. And over time, over long periods of time, this habit smooths out the volatility, reduces your risk, and gives you the best chance of building real, lasting wealth. Now, I'm not telling you this habit will make you rich overnight. It won't. I'm not telling you that you'll never see your account value go down. You will. Markets fluctuate. That's what they do. Sometimes they go up, sometimes they go down, and sometimes they go nowhere for years. But if you maintain this habit, if you keep investing through all of it, history suggests very strongly that you'll come out ahead. You'll build wealth. You'll reach your financial goals. You'll set yourself up for a comfortable retirement and maybe leave something behind for your children or your favorite causes. The wealthy understand this. They really do. The people I know who have substantial wealth, who've built it themselves rather than inheriting it, they almost all share this characteristic. They think long-term. They're patient. They don't get rattled by short-term volatility. They don't abandon their plans when things get tough. They maintain their discipline through good times and bad. And that discipline, that consistency, that patience compounds just like their investments do. So here's what I'd encourage you to think about. What kind of investor do you want to be? Do you want to be the person who's always busy, always worried, always trying to outsmart the market, always reacting to the latest news? Or do you want to be the person who has a plan, who sticks to that plan, who invests consistently no matter what, and who trusts that over time, this simple habit will lead to wealth? Because I'll tell you, from someone who's been doing this for more than 70 years, the second path is the one that works. It's not as exciting. It won't give you stories to tell at parties about how you made a killing on some stock. But it will give you something much better. It'll give you financial security. It'll give you peace of mind. It'll give you the freedom that comes from not having to worry about money in your later years. And isn't that what we're really after? Not the thrill of the trade or the excitement of trying to time the market, but the quiet confidence that comes from knowing you've built something solid, something that will last, something that will take care of you and the people you love. The simple habit that separates the rich from everyone else isn't complicated. It isn't mysterious. It isn't reserved for the elite or the brilliant or the lucky. It's available to anyone who's willing to embrace it. Invest regularly. Invest consistently. Invest patiently. Don't try to be clever. Don't react emotionally. Don't interfere with compounding. Just keep putting one foot in front of the other, month after month, year after year, decade after decade. That's how wealth is built. Not through brilliant trades or perfect timing or insider information. Through consistency, through patience, through the simple, boring, powerful habit of showing up and putting money to work over and over again for as low as it takes. If you can develop that habit, if you can maintain that discipline, you will be wealthier than 99% of the people out there who are trying to be clever. You'll sleep better at night. You'll worry less about the daily ups and downs. And one day, probably sooner than you think, you'll look at your account and realize that something remarkable has happened, not because you did anything remarkable, but because you did something simple consistently for a long enough period of time. That's the secret. That's the habit. That's what separates those who build lasting wealth from those who don't. It's not magic. It's not luck. It's just discipline, patience, and time working together to create something truly valuable. And now that you know it, the only question is whether you'll practice it.